Hello, Dr. Dolly. I am a hospital-employed anesthesiologist, 3 years out of residency, working for a large, private, not-for-profit hospital system in the Southeast. I currently max out our hospital's 403B and 457 plans, have a 401A contribution from my institution, and max out my Roth IRA. Our new CEO recently championed and introduced a new retirement plan option based on a split dollar life insurance loan regime plan he had at his prior job. The underlying product this plan is using is a fixed index universal life policy. I have read extensively on your site about the perils and disadvantages of FIULs. However, since this plan is being administered through my institution, its structure is different than that of commercially available FIULs in that my hospital system decreases my salary to the amount I select and then places that amount as a pre-tax loan plus a 15% match on top to cover the majority of insurance and death benefit expenses. While I understand the annualized returns on this product are very unlikely to rival an after-tax stock portfolio, the ability to decrease my income tax burden while also giving me the ability to loan money out to myself tax-free seems very attractive. Do you see this as a beneficial vehicle for retirement and or decreasing my annual taxable income? And if so, how do you recommend I determine how aggressively I should fund this new option? Thank you again for everything you do, and I hope this email finds you well.
Okay, so this is a complex question. I have got a post all written all about split dollar life insurance. I've titled it Why I Hate Split Dollar Life Insurance. It'll run at some point in the next few months because I get this question by email pretty frequently, once or twice a month probably, from somebody whose hospital is putting a split dollar plan in place. I think the best way to think about this to be able to understand what's going on is that a cash value life insurance policy is being sold to your employer. If you will remember that, you will understand split dollar life insurance. And so is it a benefit? Well, think of it this way. If somebody else is going to buy me a whole life insurance policy, I'm going to take it. It's not that the asset doesn't have value. It does have value. I wouldn't buy it myself, but I'll take it if somebody else is going to buy it for me. And so with the split dollar life insurance plan, what your employer is usually saying, and every one of these is a little bit different, is that I'll pay part of it. So the employer is now paying part of it, and you are paying part of it. Well, now is it worth it to you? Well, it's harder to say. If they're paying a big part of it, it certainly is. If they're only paying a tiny part of it, maybe it isn't. So the first thing I might do if this was something coming from my employer is try to talk my employer into offering me something else. Maybe putting a cash balance plan in place instead. Or talking the employer into, if they really want to do this and think it's awesome, into paying the lion's share of it, at which point it's probably worth taking for you. But if I found myself paying for the majority of the premium, I get a lot less excited about it. Then all the downsides of dealing with cash value life insurance come into play. And I've outlined these many, many times on the blog and on this podcast. In essence, it isn't that there are no benefits to it. It's just that you end up paying too much for the benefits. And you can see why an insurance agent would go to your employer and try to sell this sort of a plan to them. Now they don't have to go to the individuals. They can just go to one company, one hospital, one CEO, and all of a sudden they've sold 30 policies or 100 policies or 300 policies. Obviously there's some massive commissions there, and this agent is making out like a bandit. So keep in mind what is happening with a split dollar life insurance policy. A cash value life insurance policy is being sold to your employer. All you have to decide is whether they are paying for enough of it that it's worth it to you to pay for the rest in order to get the benefit. Typically, what happens when you separate from the employer is you can take the policy with you. You can buy it, essentially from the employer and take it with you. But then what do you have? You have a cash value life insurance policy that you really have no need for, trying to convert it into some sort of weird retirement plan for you. So you got to keep that in mind. Now, this post I've got coming out is going to go into all the nitty-gritty details. There's several different types of this. They call them an economic benefit plan. They call it an equity arrangement. They call it a loan plan. And I go through what you should do with it. And that post will be running here within the next few months, I'm sure. I'll also discuss whether you should keep it after you separate from the employer. But I end that post with a section about whether the employer should offer this benefit. And my opinion is no. If you're an employer, don't get suckered into buying these things. Offer your employees something they really want. If you're going to put a bunch of money into a benefit, put a cash balance plan in place rather than a split dollar life insurance plan. It's not that awesome, no matter what that agent is telling you. I think in this case, you said that the employer's only given you a 15% match. So they're only paying for 12 or 15% of this policy. That doesn't sound very awesome to me. I might just pass on it and just take the money in salary and invest it elsewhere. We mentioned real estate at the beginning of the podcast. Maybe this is money that you could invest in real estate, just out in a taxable account instead of messing around with this cash value life insurance plan. But really, if you're going to invest in this thing, it's a lifelong commitment. You really need to understand it, understand what you're buying, how it is likely to perform under various different economic situations, and go from there. And that gets even more complicated when it's not a whole life policy they're offering, when it's an index universal life policy. Now you got a gazillion moving parts that you got to keep track of. So good luck with that. The bottom line is if the employer buys a lot of it, you might as well take it. If you're having to buy all or almost all of it, I'd probably pass on it. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.